It's time for Stock Picks. We're taking a closer look at Meta Platforms, Netflix and Tencent, three global companies competing for your screen time. And joining me in studio with his analysis on these counters is Seleho Tsatsi from Anchor Capital. Seleho, thank you so much for your time today.
Pleasure. In
the tech sector, kicking things off with Meta Platforms, this month and maybe late January has been quite a busy month for the tech counters, numbers out from the Mag 7. We've gotten like really mixed response on those numbers, but Meta seems to be coming out tops. Why is that? Are we perhaps starting to see some of those AI investments paying off when it comes to Meta?
Yes, I think if you look at, as you said, the Mag 7 and their reports for December 2025, one of the big themes that came through was just how much capex they are, spending on AI. Together, if you take the big four, they're spending about $600 billion just this year on capex, most of that going towards AI spend. And so I think the market is starting to get, or has been for some time now, getting more cautious on like what this means, in terms of returns, what kind of returns are they going to generate from this spending. But in terms of your question on Meta, yes, they are seeing returns on this capex spending. To illustrate that, they're saying that revenue for the first quarter of 2026 is going to grow by about 30%, which is incredible if you think about the fact that this is a $200 billion revenue company, growing revenue at 30%. So what they're saying is they're seeing engagement growing and better recommendations because of their AI spend, and that's why they're really doubling down on that.
Would you say that Meta is positioning itself as a front runner when it comes to AI? I'm just thinking of some of the deals it's sealed, some of the acquisitions it's made. Most recently, we saw that Meta and AMD deal, the Meta and NVIDIA deal as well.
Absolutely, yes. Mark Zuckerberg, if you listen to the earnings calls or him on any in any interview or podcast, he really doubles down on the fact that he thinks that this is a huge opportunity, but also that if they don't pursue this, it could be existential for Meta and their peers. I
mean, there has to be leaders and laggards, right?
Yes, yeah. And I think what is admirable is the fact that he is a founder CEO. So, he's got a lot of skin in the game, financially and also reputationally. He's obviously been there since 2004. And really, if you look at, as you said, some of their acquisitions, for example, they acquired Manus. So that's a company in Asia that's focused on AI agents. So I think this is something that they do see as existential, yeah.
Just talking about the sector at large and perhaps the tech counters that are looking to benefit from this AI boom. I was chatting to another analyst, I think it was Caroline Kremen from AdviceWorks, and she said, the concern, the worry is that before we'd see these capital light sort of tech companies really just coming through with hefty bottom lines, profits. But now we're seeing them moving from capital light to a more capital intensive sort of companies. Would you say that a number of these tech companies are in a transitional phase?
I almost want to get up and dance because I agree with what you're saying so much. I think there is this big question mark about what this means, all of this spending means for these companies. I saw an interesting stat the other day that Microsoft, for example, is spending a higher or has a higher capex to sales ratio than ExxonMobil did at the height of the shale boom in 2014, 2015. So the capital spending has really changed the capital intensity of these businesses. I do think that there is an element of this being discretionary. Yeah. So I do think Meta, Alphabet, Microsoft to a degree, they have the ability to pull back if they deem that they're not seeing a return. But at the same time, I do think there is also an element of this that isn't discretionary, where if your peers are spending and you feel that you're going to get left behind, it's a big risk to take if this ends up paying off.
I mean, we saw what happened with Apple, but let's not get into that because of time. Let's move over to your second pick, that being Netflix. turning into the streaming services company there. Kicking your analysis off, I'd like you to maybe chat about what's in the headlines, right? We do know that Netflix is gunning for Warner Brothers' assets. In the meantime, we have Paramount with that new bid coming through. Walk me through how important this bid, or rather getting those assets, is for Netflix, because it does seem like a do or die sort of situation for Paramount, but not the case for Netflix.
I think so. I think this is a nice to have for Netflix, but it's not a have to have for them. As we've seen, for the last few years coming up into 2026, they've been able to grow the business at a very attractive rate. They now have 325 million global subscribers, by far the leader in terms of streaming. We've seen the likes of Disney, for example, struggle to match the subscriber or streaming revenue growth that Netflix has. So I do think that they are by far and away the leader in streaming.
Yeah.
This would be a nice add-on. They've described it as an accelerant, them buying Warner Brothers Discovery. But I think if they were to walk away, or if Warner Brothers was to choose Paramount, Netflix would get a very nice breakup fee, and they could continue to grow their core business.
All right. Talk to me about, I guess, Netflix is positioned within the market. You did say it's literally the biggest global streaming company. What's interesting, though, is that one of its biggest competitors is YouTube.
Yes, and Ted Sarandos, one of the co-CEOs of Netflix, has been at pains to point out that YouTube is one of Netflix's biggest competitors. And the reason why he's trying to do that is because obviously Netflix wants to show that the definition of the market should include YouTube for regulatory or anti-competitive purposes. They want to show that they are, they're not going to dominate the TV market. YouTube is still a big part of it. And I think that is true, to be honest. I think that is a reasonable assumption to make. As a consumer, you have a choice when you get home and you get on your couch, you can choose YouTube. There's very high quality content on YouTube, or you can go to Netflix or other streaming services. I do think that they are substitutes.
I must say that physically I'm here, but my mind and my heart are at home trying to watch the new episodes of Bridgerton.
Okay, I don't watch it, but I'm aware of it.
It's amazing. Yes. You should get on it, please. Let's move over to your last pick, and that being Tencent, sticking with tech, but within China, right? Your pick there, Tencent, as I mentioned, easy access for South Africans through NASPIS process. Yes. Your analysis on that counter, we have seen the share price sort of consolidating. At some point it was in the red, but towards the end of the month we did see a lot of these Chinese tech shares consolidating. Why are you buying it at the moment? Why are you seeing I guess interest in it right now?
Yes, Tencent had a phenomenal 2025 in terms of share price performance. As you said, it has started 2026 off in a bit of a shaky manner, just in terms of its share price. What's really interesting about the share at the moment is that emerging markets as a whole have really done well, but Tencent has lagged. And I think part of that is that the market is looking at Tencent and it has a few questions on its AI strategy, whether Tencent is being aggressive enough within AI compared to a peer like Alibaba. I think if you look at Tencent's earnings and what they've produced over the last year or two and what they're likely to produce over the next couple of years, we think they can grow in the mid-teens roughly, which is quite attractive for a business that's on about 14.5 times earnings.
So concern is really about the next phase of growth for Tencent.
I think concern for Tencent from some investors is around whether they're being aggressive enough with AI. Yeah.
All right.
We don't really share that concern, but yeah, we think that is one of the concerns.
Another sour point when it comes to Chinese stocks is regulation. Yes. And about 3 weeks ago, there were growing fears that authorities may raise taxes on internet companies following a recent tax increase affecting telcos firms. Just your take on, the regulatory environment over in China and how it impacts your strategy when looking to pick up some of those stocks.
Yes, I think one of the ways that we try to deal with that is by going with what we think are the best businesses in China, the most diversified, the most able to withstand regulatory shocks. Speaking more generally about what's happening regulatory-wise in China versus other parts of the world. I think it is worth pointing out that in the US, we're seeing quite a bit of regulatory intervention.
Yes.
So, for example, we're seeing the US president suggesting that one of Netflix's board members should be removed. And obviously, we've seen the US president and this administration get involved in business quite significantly. So I wouldn't say that China is the only place where you see the government stepping in.
Okay, and just lastly, before I let you go, I want to get your sense, your take around the US and China AI race, right? And how China sort of fares up at the moment. We did see a lot of noise last year after the whole DeepSeek situation, but sentiment, interest has somewhat died down since then.
Yes, we think that China is really 15 seconds behind the US. So we think that there isn't a humongous gap. And we've heard similar sentiments from Jensen Huang, the NVIDIA CEO. Elon Musk, for example, said that he thought Tesla is the best self-driving company in the world. But he thought numbers 2 to 10 would all be Chinese. So he really thinks that China is a huge competitor. If you look at open source AI, China's dominating there. The US definitely does dominate in the closed source models. So OpenAI's ChatGPT, Anthropic's Claude, etc., they do dominate. But we are seeing that the Chinese are moving heavily in open source.
All right, let's leave it there. Seleho, thank you so much for your time and sharing your analysis with us today. That was Seleho Tsatsi from Anchor Capital.